As a business owner, you've heard of friends saving hundreds of thousands of dollars in taxes. Well, today we're going to look at a strategy that you can implement that could also save you hundreds of thousands of dollars in taxes. So it's called a Roth conversion. And we're going to look at an analysis to break down the ins and outs of what a Roth conversion is and how you also could save hundreds of thousands of dollars in taxes over your lifetime. My name is Luke Turner, co-founder of Moment Private Wealth. We help athletes and entrepreneurs get smarter with their money. Let's dive in. As I mentioned in our intro, what we're going to be talking about today is what's called a Roth conversion strategy. So before we talk about some of the assumptions we're going to be utilizing when we look at a Roth conversion strategy, first, let's look at the basics. What is a Roth IRA? So a Roth IRA, the end of that IRA stands for individual retirement account. The prefix before it, so the Roth, means that those are after-tax dollars, meaning you're not going to get any tax benefit by putting money into a Roth IRA, but you are not going to pay any taxes on any of the growth, and when those dollars come out, they're going to come out completely tax-free. Whereas in a traditional IRA, again, the end of that is the same, individual retirement account, but that prefix traditional means that you're going to get a tax benefit today. That money is going to grow tax deferred, but then when it comes out, you're going to have to pay ordinary income taxes on it. So one strategy that we look at implementing for many business owners is what's called a Roth conversion strategy. And it's one of the strategies that often gets overlooked because it's going to actually require you to pay more taxes today, but if executed properly, it could save you hundreds of thousands of dollars in taxes in the future. And we're going to look at a real life scenario today to look at what that could look like for you as a business owner. So let's look at our assumptions before we dive into the analysis itself. So what we're looking at is a business owner who currently has a tax rate of 37%. You can see that on the left-hand side of the screen. We're assuming that this business owner is making $1 million of income, so he's going to be in the highest federal tax bracket, which is 37%. But what we're assuming is that when he goes to take distributions out in the future, he's actually going to be in a lower tax bracket, the 22% tax bracket. And so again, most of the time when we see business owners, what happens is they make a significant amount of income for a significant period of time. But then once they sell or exit their business, typically the income goes down because they are not actively involved in operating a business. Obviously, this isn't always the case, but for example purposes today, this is what we're going to assume. And then some of the other analysis assumptions you can see over on the right-hand side of the screen is that, one, we are assuming that we are going to convert $500,000 that's in an IRA into a Roth. Okay, so again, think about this as your 401k or your IRA. Both of these are taxed very similar from a tax code perspective. So we're assuming that we're going to do a one-time $500,000 conversion. We are assuming that we have a very long time horizon, 40 years until we actually need to distribute these monies. And we're assuming that we're going to pay all the taxes upfront in cash. Okay, so these are our assumptions. So how does this actually play out in reality before we look at some of the numbers behind why we might want to do this? So first off, if we do a $500,000 Roth conversion, what this means is we would take $500,000 that's in your IRA and we'd move it into your Roth IRA. When that happens, the federal government's going to say, well, Bob, we gave you a tax benefit for putting that money into the IRA. We need to make sure that you're paying taxes now that you move it to the Roth IRA. So when you do that Roth conversion, the mechanics or the logistics of it are you're going to move $500,000 from your IRA to your Roth IRA. And then in that year, it is going to be as if you made an additional $500,000 in income. So what that looks like in this scenario, if you're in the highest tax bracket, is that you would pay $185,000 in taxes. And we are assuming that you are going to pay that out of pocket. Okay, so some Roth contribution, Roth analysis say, well, why don't we just pay it out of the money that we convert? That is not the best way to do it from an overall tax strategy perspective. So typically, we are going to pay those taxes out of pocket. So you get that full $500,000 that's going to stay in that Roth IRA. So that's the mechanics. So now let's look at how does this actually play out over the course of time. Okay, so our first chart that we put together here is looking at what we would call a break-even analysis. So if you are looking at this chart, what you can see is what our overall expected tax is going to be on the left-hand side, and then our years until distribution. So what we're looking at here is, if we do this conversion, when are we likely to see a return on our investment? Because remember, we are going to write a check of $185,000 to the government. And that's a big number. We want to make sure that we're getting our return on investment. And this is what's so important to understand, is that the longer your time frame, the more likely this strategy works. And what I would tell you is, this is an extreme example because you can do this in bite-sized chunks. But what I would tell you is, there's a lot of people that are not in the highest tax bracket that also should be looking at this strategy. But what we see when we did the analysis is that it takes 12 years for us to break even. But if we are continuing to compound these dollars, again, completely tax-free, after those 12 years, we have a huge benefit that we can see that just continues to compound over the course of time. And one thing that's helpful to look at is not only what is our expected overall tax rate going to be, but what does this actually look like in terms of dollars? Okay, so now let's look at the first piece of analysis. So when we look at the analysis of a Roth contribution, we're looking at a couple of things. One, what are we going to have to owe in taxes today, which we already talked about, that $185,000 number. And then two, what is our overall tax rate going to be if we have this situation play out over the course of time? Because remember, once we convert these dollars, we're never going to pay taxes on any of the growth ever again. So every incremental year that those dollars compound, our effective tax rate that we paid continues to decrease. So you can see in year one, it starts at 37%. But when we get out into that 40-year distribution period, we're actually below 6%. And one of the helpful break-evens to look at is, what is the actual time frame it takes for us to have a return on our investment? Because at the end of the day, if we're going to pay $185,000 in taxes, we want to have a return on our investment. And right now, what this looks like in this analysis is that after 12 years, we would expect to have a return on our investment. So again, this is not a short-term play. This is a long-term play if it's something you're looking to implement, but it can be very effective. And not only is it effective from a tax rate perspective, but it's also very effective from a dollars and cents standpoint. So let's look at how many actual dollars do we expect to save or have in our pocket if we implemented this strategy. Okay, so now that we've looked at the tax rate, now let's look at what are the actual dollars that are going to be in our pocket if we were to implement this strategy. So what you're looking at here on this chart is a chart that outlines, one, if we just left our money in the IRA, and then two, if we actually did this Roth conversion. So this darker green line is what we see as the additional monies that we would expect to have, taking into account the growth in the market, taking into account tax rates. And this bottom section would be if we did not do the Roth conversion. So again, just like I mentioned on the last page, this is a long-term play. Our break even still at that 12-year mark. But one thing I think is very important to point out is that as we get further and further down the road, the compounding effects continue to be amplified. When we look at this 40-year distribution window, we actually would expect to have over $857,000 more in our pocket if we implemented this strategy. So again, it's a long-term strategy, but we're talking about nearly $1 million in tax savings if you are able to implement this over the long term. So to summarize our conversation today, the most important thing to understand with Roth conversions is that you need to have a long-term strategy. This should not be something that is willy-nilly, that you go out and you watch this video and you just start converting money. There needs to be a true strategy in place that's taking into account both your tax rate today and your expected tax rate in the future. And then an analysis needs to be performed to see where the break even is and if it makes sense for you in your specific situation. If that's something that you're interested in and you'd like to get a free analysis done, you can check out the link below where you can schedule a meeting with the founder of the Moment team. Have a great day.